What up? It's your boy Carlo, back at it again. So today I'm gonna be talking about mutual funds versus ETFs, as well as index funds. So I'll be talking about the differences, the similarities, and how you can understand it and utilize it in your own portfolio. So just jumping right into it, I actually wrote a little text so you could follow along with me. So first thing that I will be talking about is mutual funds. So mutual funds are basically investments that pool money together with you as well as other investors to purchase different stocks, bonds, and any other type of securities. So the overall fund of stocks, bonds, and other securities are considered a portfolio. So basically, that fund has an objective and an investment approach in how they invest the money for their investors. So, going over the mutual funds, there are two types. One are actively managed funds. So right here, what I have on the main screen right here is the Prime Cap Fund Admiral Shares by Vanguard. So this one is an actively managed fund by the Prime Cap Management Group. So what is an actively managed fund? It basically is a fund where a fund manager buys and sells securities actively, so all the time, anytime, whenever. And when it buys and sells securities, whether it be the stocks, the bonds, or any financial instruments, it has a higher turnover ratio. So just like in a job, whenever there's high turnover, there's a lot of people coming in and out. Same thing with the mutual fund. A lot of different stocks, bonds getting bought and sold. So with that being said, having a higher turnover, there are tax implications. So those tax implications are passed on to you as an investor. So it can be the capital gains tax as well as the dividends. So higher expense ratio is incorporated due to these tax implications. And basically what the expense ratio is for a mutual fund is the annual fee that the fund charges to the investors to pay out the fund managers. So if you look over here at the website, the expense ratio is 0.31 for an actively managed fund, which is actually for Vanguard pretty really good. Because there's definitely, I've seen some actively managed funds that are like 1% and above. So definitely this Prime Cap Admiral shares are really good. And as I was saying, the higher the expense ratio, the higher the cost of the fund. So for us to be a part of the fund, it's actually going to cost us more money to pay out to the fund manager to manage our money for us. So there's definitely been a lot of research done that higher expense ratios decrease the return over time. So it's something that you really need to pay attention to when researching and investing in mutual funds. So with actively managed mutual funds, a key thing to do, you must research the fund managers as well as the management group and their track record over time. So when you look at the Prime Cap Fund Admiral shares, they do a really good job compared to their index. So things to look at. Number one, the objective. So when you look over here at the objective, let's make this a little bit smaller. Prime Cap seeks to provide long-term capital appreciation. So anytime you guys see capital appreciation, it basically means aggressive growth. So it's a little bit more risky. And then also look at number two, their investment approach. So how they invest the money. So it has large cap, mid cap, capital appreciation, aggressive growth, as well as comparing their investments to the S&P 500. So with the S&P 500, they use that one as a benchmark. So S&P 500 is the 500 large cap stocks. So it would be 500 stocks in that index. However, when you look at the prime cap actively managed fund, they only have 140 holdings of that S&P 500. So going back to it. So also when you're looking at investing in that mutual fund, those are like the four main important things: the objective, their investment approach, what they compare their portfolio to, and the expense ratio, the cost, the annual fee to invest in that mutual fund. So why should you guys consider investing in a actively managed mutual fund? Is because you want to try to beat the market index. So looking right over here at the actively managed mutual fund, this prime cap fund actually has been doing better than the S&P 500. So when you look at their tenure over time, they be in a 10-year average 2%, 3%, 3%, 2%. So definitely when you're looking at actively managed funds, those are things to consider. Yes, it might be a little bit more expensive out of pocket to invest with the actively managed fund, but you always have to look at the investment group doing the management. So next part, we're going to move on to passively managed mutual funds. So this one right over here. So passively managed mutual funds are basically index funds. So why invest in a passively managed mutual fund is because long-term diversification for your investments, low turnover ratio. So basically they're not always buying and selling securities, bonds, stocks, whatever you may have, and also lower expense ratios. So this one right here is the total stock market index, Admiral shares. Dude, that was a total stock market index fund, Admiral shares. Say that 5 times really fast. So just getting back right into it. Expense ratio 0.04 for the passive. Going back to the active, 0.31 right over here, 0.31. So definitely a lot more expensive for the active. But with this one, the index fund, it tracks the overall total stock market for this particular fund. Lower turnover ratio, lower expenses, and a lot more tax efficient with the capital gains as well as the dividends. And as I was saying, with each particular mutual fund, always look at the objective, investment approach, their benchmark, as well as the expense ratio. So looking at the passive, right over here, it seeks to track the benchmark of the overall stock market. The benchmark is the CRSP, Total Stock Market Index. The cool thing with passive index funds is that with this one in particular, it has the large cap, mid cap, as well as small cap. So you don't have to invest in 3 different funds. It's basically an all-in-one fund to own the overall total stock market. And looking at the expense ratio, boom, definitely really, really low. And as you could see, the net asset value compared to the benchmark, so the net asset value is the actual index fund. So it's basically identical with its performance. So indexing, following the index. And if you look at the holdings, where are the holdings at? Boom, 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 boom. Oh my gosh, I'm blind. Where is it, guys? Right here. Has 3,573 of investable companies within the total stock market. So that one right there and comparing it to, and what I was saying earlier, the turnover rate right here, 3.4. Compare it to the active, 8.3. So how you know it's active versus passive? Active, higher turnover rate, higher expense ratio. Passive, lower expense ratio, lower turnover rate. And then mutual funds in general, whether it be active or passive, they execute trades at open or close price. So whether it be the open of the day or the close of the day. So what I mean by that, so say you want to buy this particular total stock market index, you want to buy it at 9 a.m. So you'll actually buy it at the open of the following day. So with this one, you can't buy at a particular price as with a ETF. So the price changes from day to day with mutual funds. And with mutual funds, there's a minimum specified dollar amount, whether it be $3,000 or $10,000. I know with the Admiral shares with Vanguard, it used to be $10,000, but they lowered it to $3,000 minimum, which is really, really good to bring in newer investors and more money into their mutual funds. So with mutual funds, it's more so with lump sum investing. As I was saying earlier, you need at least $3,000 to invest in one of these mutual funds. And when you look at mutual funds, you need to look if they're open or they're closed. So with this one right here, it's open to new investors. And when you look at the actively managed fund, it's closed to new investors. So the main reason why certain funds would be closed is because the fund got too big, a lot of money, and definitely easier for the fund managers to allocate the money more efficiently. So moving on. And certain mutual funds have front end and back end fees. So definitely you have to look at that. So it's just more added on fees when investing. And just in general, the mutual funds are not as liquid as ETFs. And what I mean by liquid is you could cash it out anytime that you want and get the money back into your bank account or back into your pocket. So moving on to ETFs. So right here, we're looking at the total stock market ETF, which is a mirror of the total stock market mutual fund. So with an ETF, they're bought and sold just like stocks. Basically, you could buy any time of the day during market trading hours at a particular price that you want. So that's why I like ETFs a little bit better. You could set a limit order at a particular price that you want to buy at. As opposed to with a mutual fund, you have to wait to the close and the end of the day, and you have to really, really monitor that price to actually buy into the mutual fund, as opposed to ETFs, a lot more easier. And with that being said, ETFs are a lot more liquid since you could buy and sell at any given time. The price fluctuates on a daily basis, so during market trading hours, the price is always changing. And with ETFs, it's better for smaller investors because you could just buy one share of VTI at 143 as opposed to investing in $3,000 for the mutual fund. So it's a lot better for smaller investors as opposed to lump sum investing. And also the expense ratios are a lot smaller on ETFs compared to mutual funds. And they're a lot more tax efficient because less turnover ratio, less capital gains tax, as well as dividend tax, so a lot more efficient. And then one last thing before I end the video, just talking about taxes. With investments, you need to make sure that you put your mutual funds and ETFs in the right place to be as tax efficient as possible. So with a taxable account, whether it's just your regular brokerage account, you want to put passive mutual funds and ETFs like this one. So either VTI or this one right over here, total stock market, because they're both passive and you don't really have to worry so much about the capital gains tax as well as the dividend tax implications. However, with tax advantage of accounts, your 401k, IRA, Roth, 403b, whichever you may have, you want to put actively managed mutual funds as well as ETFs into these tax advantage of accounts because of the capital gains and dividends. Since it is a tax advantage vehicle, you don't have to worry about it. So hopefully you guys enjoyed this video. Hit that subscribe button, hit that bell notification. I really hope you enjoyed it. I'll see you guys next time. Peace.